All right, what's going on, everybody? It's Friday, May 31st, and my doggy friends in the background. All right, there's a lot I want to talk about today, so let me get right into it. First of all, I want to mention right off the bat that I've been telling you guys since a month when the Atlanta Fed came out with its first second quarter forecast for GDP. Remember, they came out at 4.2%. And I said that was a wacky forecast. And I've given them credit on these videos and also in the past that they're usually pretty accurate. I said that is absolutely going to be revised down. We had then following 3 consecutive weeks of lower revisions, and we just had another lower revision today. I think it was down to now like 2.5% for second quarter GDP. I think it's even going to be lower than that, okay? I think they're going to revise it down again. So I told you guys, based on what I was seeing with the fiscal flows, their initial forecast of 4.2% was absolutely way off the mark, and it was going to be revised, and that is exactly what has happened. So if you still hold on to any view that what I look at, these flows, which I call the first derivative of economic activity, if you still think that that's some kind of, hocus pocus, I mean, I tell you this stuff in advance, okay? And it ends up to be true, okay? Because that is the first derivative of economic growth. By the way, the New York Feds, they have a GDP Nowcast. They have their own forecast called the GDP Nowcast. That's also been revised lower. Now it's at 1.76% for second quarter GDP. And again, I said that it was going to be second quarter GDP. I said it was going to be less than the first quarter, which, by the way, was just revised down yesterday to 1.3%. I said it was going to be that or maybe even less. Like, growth may slow to a crawl, okay, because of what I'm seeing with the drop in net government transfers, aka the deficit, okay? So that's number one. Number two, there was a comment on here, and I don't usually respond to this in YouTube's, but it's saying, Mike, you're a funny guy. We like your videos, but it seems like you just kind of make stuff up to justify what's happening in the market. And that is so far from the truth, because I tell you guys in advance, many times months in advance, quarters in advance, year in advance, what is going to happen based on these flows, and it plays out. And sometimes there's a little nuance in that, because I say, we can be in a cycle now, a quarterly cycle, where you can have a peak in the flows or a drop in the flows, and that's maybe like a trading opportunity for the markets. But I tell you all this stuff in advance based on these flows, which are known. It's not like something they just pop up unsuspected. I mean, we know, like I said the other day, Congress sets a budget. We know what spending is going to be. A lot of the spending, as a matter of fact, the big items are non-discretionary. Okay, so they happen automatically. Now, I've been saying now for weeks and weeks that there's a slowdown in economic growth which is occurring, and the stock market was not reflecting that, but it will, okay? I said it will. I've been saying that the rally is speculative. I've been saying that I am not a fan of this rally. I made a video a couple of weeks ago with that exact title. But I said that we're going to have a period. As a matter of fact, today I sent out to my subscribers in the morning, I said we're having first of the month payments. That's the big payments flow day. They're split up between half of it today and half of it on Monday, because June 1st is tomorrow on a Saturday, all right? So they split it up. I said that those flows, which are strong on the first of the month, we're going to have a bounce today, and we'll get a bounce on Monday. But this today, let me just speak quickly to today's, that 600-point rally in the Dow Jones. That was like panic buying. It looked like to me, end of the month window dressing, panic buying mixed in with short covering, and the monetarist zombies. This morning we had a PCE, the personal consumption expenditures. That's supposedly the favorite index indicator of the Fed. That's what they call it. I have no idea if it is or not. It came out a little bit cooler than expected. And so I said the monetarist zombies, I sent it out this morning. I said the monetarist zombies are going to buy now because, maybe they're going to cut interest rate. You know, this whole thing is so ridiculous about the rate adjustments all the time. I mean, they got it all wrong in 2023 with the rate hikes, which I told you guys that the rate hikes were going to lead to a major expansion in interest income transfers into the economy. And I'm telling you now that the rate cuts, if they ever happen, they're going to lead to the opposite, which is a reduction in those interest income transfers. It's actually, draining out that money, that income from the economy. That's not a bullish thing. We're going to have very slow growth, if at all, when they start to cut. So I tell you this stuff all in advance, and to say like I just make it up to justify, I'm not only giving you the macro picture, which is totally correct based on what's happening with the first derivative, these flows. But then, as a courtesy, I throw in like some of these cyclical cycles that are going on based on when the flows will peak, when they're going to come down. I don't know what more you want me to do, actually. And I don't know how many times I have to repeat that. Nobody else out there does this. I mean, 100% of the analysis that comes from the financial industry is completely and totally focused on monetary policy, which they don't even understand. Okay? So they have a backward understanding of monetary policy. That's all you're getting from them. If you don't watch this channel, and really, it's only this channel, it's only me, it's only my report. You can't even get it from other MMT people. These academics, they're not traders. They don't understand. They understand the theory of MMT. They're well versed in that. They could speak on that. They could explain that. But Stephanie Kelton is not a trader and not an investor based on these concepts. I don't even think Warren Mosler is anymore. I mean, I've spoken to him about flows. He kind of like ignored it, all right? Which I found was very, I was curious about that. Like, what, this is everything. This is everything, okay? So you're not going to get it anywhere else. And to say I make stuff up to justify what my view is at the moment, I mean, that's just total nonsense. That's total nonsense. I tell you guys months, quarters, years in advance, like what the landscape looks like. I'm saying right now that growth will come down to a crawl. That's not necessarily really, really negative for the stock market, like it's going to be a bear market. But it's going to absolutely slow the rate of ascent. You're going to have a correction here. This 600 points today up in the Dow was ridiculous, okay? And I'm telling you right now, you could have some follow-through buying on Monday or early next week based on the second tranche of these first of the month payments, as this liquidity flows in. But it's not going to last. How many times have I told you guys that stocks follow the economy, not the other way around? And I don't care if you're looking at NVIDIA and if you're looking at whatever the hot topic of the day is. If the economy is growing, the stock market over time will go up. It's very simple. If this economy is contracting, the stock market will go down. to a point. There's automatic stabilizers built into the system that keep the economy from staying down and continuing to contract and contract and contract. Because the automatic stabilizers, it's the same thing as what we're seeing now. You might say, well, Mike, what's causing the slowdown in flows? It's not really a slowdown in the leading flows. It's a slowdown in the net flows. That means you look at the leading flows and then you subtract taxation. What's left? What is that stock of financial flows that is left in the economy after you take away the taxes? That's shrinking, because what's happening now, the phenomenon that is happening now, is the opposite of the automatic stabilizers, right? The automatic stabilizers, like when the economy contracts, people lose their jobs, they go on unemployment benefits, Social Security, disability, all these things. So that's an automatic expansion in government spending as people seek the help of those programs, okay? On the flip side, when the economy expands, it kicks off more taxes to the Treasury because you have incomes that are rising, wages that are rising, profits that are rising, and you get to a point where the tax flows, the rate of tax flows exceeds the rate of spending, and then the net flows start to shrink, and that's where we are right now. In order to compensate for that, if you wanted to keep the economy growing at 4 or 5%, in order to compensate for that, you'd have to have tax cuts, or you'd have to have an increase in spending, which would offset what's happening with these tax flows. You get it? So the stock market is going down from here until we reach some new equilibrium level. And I suspect that the April-May rise, well, the Dow nearly gave back the entire thing. I mean, if you don't count today's ridiculous 600-point, and it happened all at the very end of the day. I mean, we were up like 280. And the last thing I look at, like, oh, where did the market close? I look, up 600? Are you kidding me? Like it was like a moonshot right at the end of the day. That's just panic buying by people who are ridiculous, okay? Nobody makes money doing stuff like that. And if you got lucky, you day traders who say, it's such a wonderful, marvelous thing to be a day trader and you can do it and blah, blah, blah. Well, more power to you if you got lucky and got long at that last, 10 minutes or 15 minutes, whatever it was. But I mean, folks, like, seriously, man. Nobody's telling you this stuff. I'm the only one who's telling you this stuff. And some of you were lucky enough or smart enough to stumble onto this channel, or maybe, heard about me or know me, and you watch this channel. Nobody else watches this channel. I mean, nobody, very, very few people watch this channel. But I try to educate you on this stuff. And to say that I just make things up, I mean, that is such a nonsensical statement, because I literally say things here quarter in advance, a year in advance. And then out of courtesy, I give you these moments which come every cycle. Every quarter you're going to have either a tax strain, or you're going to have an interest payment. So with the interest payments, you'll get a spike in the flows, and the market will react to that. With the tax drains, well, you know what happens. We've been through that in April. And by the way, there's still $147 billion that needs to be recovered. So it'll be close to all being recovered by next week. But then the week after, we get hit with another tax drain again. Okay? And the main thing to understand right now, if you're thinking about, well, what's the market going to do right now, is very simple. Economic growth is slowing down because these net government transfers are shrinking. Another way to say that is the deficit is shrinking compared to last year. Less is going into that swimming pool. The level of the swimming pool is lower than it was last year. You can't expect the same kind of economic growth as we saw last year. And stocks have gotten ahead of themselves because these earnings, remember, these earnings are based on a prior quarter, all right? And as much as these CEOs try to look out in advance as to, to provide guidance, they're not always all that correct. And if they hit their numbers in a weaker economy, it's probably only because of cost cutting, okay, not revenue growth. And what does cost cutting mean? It means laying people off. It means less investment. So you can't get around it. That's what it is. Anyway, that's it for today, folks. Please like and subscribe if you choose to. It helps the channel. And don't forget, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial of MMT Trader. I'm the only one who does this stuff. You get a lot more information with the subscription. Have a nice weekend. Bye.